We're looking at an analysis report on intuitive machines, ticker LUN, that makes a really bold bull case.
A very bold case. It's got an $800 million acquisition at its core, a $16 price target, and it's basically framing LUN as the next space prime.
It does a great job outlining the catalysts, but we think there are a few places to really deepen the analysis to justify that very ambitious title.
Exactly. The core story is exciting, no doubt. LUN moving from just a delivery service to this, vertically integrated player.
Right.
Our job here is to help build the intellectual scaffolding around that excitement. We need the rigor to back up the rhetoric.
Absolutely. So let's start where any serious analysis has to. The financials.
The runway.
The analysis lays out the key Q3 2025 numbers pretty clearly. You've got $52.4 million in revenue, a $10 million net loss, and this huge cash position, $622 million.
And the conclusion is basically that this cash gives them enough runway.
Which it does on the surface, but this is our first point. The analysis really needs to integrate that financial loss and the cash burn more strategically.
Strategically.
It needs to connect them to the timeline to maintain, analytical balance.
Okay, so what's the gap then? What happens when you just list the cash and the loss next to each other?
Well, it frames the cash as just this generic safety net.
Right. A static asset.
Exactly. Not an active strategic tool. And that approach, it sort of minimizes the real urgency they're under to convert that backlog into actual profit.
And it fails to answer the big question, which is why? Why should the market be okay with this burn rate right now leading up to these huge catalysts?
Like the LUNR deal closing in Q1 2026.
And the IM-3 mission later that year. I mean, cash is great, but cash burn always has an opportunity cost. It implies something if it's not tied to real progress.
So the goal here isn't just to state the cash balance. It's to define its specific job.
Yes, its function. What is that $10 million loss doing? The material should quantify the value of that $622 million against key milestones.
So tying the loss to specific investments.
Are they hiring people for the LUNR integration? Are they buying parts for IM3? If that $10 million is a productive investment, we need to see that baked into the narrative.
I think this is where a sophisticated investor might start to check out. We have a very, very long runway, but these deadlines are incredibly tight.
That's the tension. The pressure isn't survival. It's speed. Execution speed.
Okay, so let's get concrete. How could the analysis frame this better?
Well, for one, instead of just saying runway, do the math.
Show the work.
Calculate how many quarters that $622 million lasts at a $10 million burn rate. It's over 60 quarters, which is huge. It shows resilience.
But then you contrast that.
But then you immediately contrast that massive number against the short-term deadline for, say, the LTV contract award. That's expected before the end of 2025.
So the message becomes, we have plenty of time to solve technical problems, but we have no time to lose in capturing these contracts.
Exactly. It shows financial mastery. And here's another angle.
Okay.
Use that $10 million loss as a pivot point. This isn't just a leak. It's the cost of growth. The analysis should then reinforce that huge projected revenue number, over $850 million post-LUNR.
To show the acceleration.
Right. You have to justify the current valuation against peers like Rocket Lab, where every dollar burn is scrutinized. You argue LUNR's $10 million loss is just the fuel needed to hit that acceleration point.
It makes the future valuation feel inevitable, not just, speculative.
That's it. You move from reporting history to forecasting a strategic path. It's a huge improvement.
Okay, that's a great point. Now let's shift to the core of the whole thesis, the acquisition.
The $800 million deal for LUNR Space Systems.
Which the analysis correctly identifies as the main driver, the thing that turns LUNR into this space prime idea. The idea is they can build their own satellites, their own comms.
And unlock that $850 million revenue projection.
Right. But this is our second critique. To really justify that space prime claim, which is a big claim to make, the analysis has to explore the strategic value and, maybe more importantly, the risks of that deal.
The integration risks.
Yes. The material is strong on the outcome, the revenue jump, the vertical integration. But for an expert listener, where's the gap?
The gap is acknowledging the complexity. It emphasizes the scope and the result, but it talks about the successful integration as if it's a certainty.
A done deal.
And for anyone who's seen a complex M&A, especially in a technical field like this, That's a warning sign. You're blending two expert teams, two supply chains, two cultures. That never happens without friction.
So without that realistic risk assessment, the $800 million just feels like a number in a spreadsheet. It lacks credibility.
It does. So the suggestion is to introduce a brief but critical look at those integration risks. Or you could flip it and highlight some non-financial benefits.
You mean benefits beyond just the top-line revenue number?
Exactly. That kind of intellectual honesty adds a ton of depth to the argument that the valuation looks much more attractive post-merger.
I'm wondering if the best way to show that value isn't revenue at all. It's synergy.
Synergy, not just scale. That's a great pivot.
How does Lanteris solve problems that LUNR already has?
Perfect. For instance, the analysis could look at how Lanteris's expertise in communications and satellite building directly mitigates LUNR's own historical risks.
You mean the orientation issues?
The tipping over? With IM1 and IM2. If Lanteris has some advanced guidance tech that can be integrated to help IM3 stick the landing, that right there justifies a huge chunk of the $800 million deal.
It shows the acquisition was about making the core business more robust, not just bigger.
And that ties directly into winning the next big contracts.
Like the LTV.
Precisely. The analysis could talk about specific integration milestones, or show where Lanteris Tech gives LUNR an edge in securing that LTV contract. It shows they bought Lanteris because they couldn't win the next generation of contracts without them.
Now, that is a strategic acquisition.
That's the definition of it.
Okay, that definitely strengthens the space prime thesis. An $800 million deal really needs that level of detail. Let's move to our final point, the elephant in the room.
Operational history and volatility.
Right. The analysis does note the successful landings of IM1 and IM2, which is incredible, but it also correctly highlights the orientation issues, the tipping, that made the market punish the stock.
So IM3 has to stick the landing perfectly, and we also know the stock has a beta over 1.0. It's volatile.
And here's the topic sentence for our third critique. The assessment of that operational failure needs to go beyond just acknowledging it. It needs to become a foundational element in evaluating that $16 price target.
Right. Right now, there's a real mismatch between the, let's say, rocky operational past and the target's faith in a perfect future.
I think any expert is going to see the volatility and the $16 target and immediately ask, where is the model that connects these two things? They feel decoupled.
They do. The operational history and the high beta are presented as separate items. One is a lesson, the other is a warning.
But they're not integrated into the valuation thesis.
Not really. That $16 target relies completely on future perfection, on IM3 succeeding in late 2026. But the analysis doesn't really model the consequences if it doesn't.
So some might say that introducing a failure scenario, like an $8 or $10 floor price, could weaken the bullish case you're trying to build.
I'd argue the opposite. Analytical rigor is what sells credibility. It's not about weakening the case, it's about making it bulletproof.
So how do you frame that?
You link the operational risk, that tipping history, directly to the financial volatility. You use that dependency to strengthen the argument for why the stock is a trader's paradise. It swings hard on mission news.
Right.
But you also justify the long-term conviction by showing you've accounted for the risk. You're essentially saying the volatility is the opportunity.
So the 16 target isn't absolute. It's a calculated reward that's contingent on success.
It has to be framed that way. I'd suggest proposing the $16 target as a contingent valuation. Do a brief scenario analysis.
Like what happens if IM3 doesn't stick the landing perfectly?
Exactly. What's the modeled impact on the stock price then? Providing a scenario for an $8 or $10 price if there's a partial success shows you've done the math on the downside. That's much more comprehensive.
That grounds the whole volatility argument in facts. It ties the technical execution directly to the financial outcome.
It replaces faith with calculated risk. And to really solidify that, instead of just saying the beta is high, you explicitly connect the IM3 mission dependency to that volatility.
Okay.
You show how LUNR's stock is uniquely sensitive to mission news compared to its peers. For them, beta isn't some generic market metric, it's a direct function of landing stability. Making that connection actually makes the bull case stronger.
Because the potential reward is priced correctly against that very specific, very high-stakes risk.
You've just turned a historical footnote into the analytical engine of the whole thesis.
That's a powerful set of recommendations. I think it really transforms the analysis from a strong pitch into a truly robust investment thesis.